Hello and a very good morning to all. We begin the week with our very own rupee strengthening slightly in front in the off market hours. But before we dive into all our updates for the financial markets, welcome back to Almus Market Mornings with me, Shikhar Garg. Now, as mentioned, INR seems to have appreciated, but the risk of sentiments might find its corner as the China has vowed for zero COVID policy and continues to stay there. And that should put some bit of a risk off, as we have already seen Aussie dollar correcting a bit on these particular updates. On Friday, we have also received the NFP numbers. So, JK, I'd like your thoughts on the NFP numbers as well as a possible risk of scenario because of China, and what else are we seeing in the markets?
Good morning. So it's been a topsy-turvy trading in markets post-Fed decision and Powell statements, and getting even more volatile on Friday with swings continuing into Tokyo hours today. Risk appetite soared on Friday as Chinese whispers swept markets last week that China had put together a conditional reopening plan, but those rumors were denied on the weekend, leaving markets facing some disappointments as the trade opened today. The two other major developments on Friday were mixed US payrolls data report and the Fed speak that was not so hawkish as one would have expected post Fed meeting and press conference by Powell. US stocks were up, down, and up again towards the close, but other major markets were holding on to their initial gains, led by China. Maximum impact on was definitely seen in China and the commodity markets. Copper rose 7%, crude rose 4%, and even the precious metals like gold was up 3%, silver a whopping 7%. Cotton futures have been up 4.7%, with the overall gains from 1 week low recording an eye-popping 22%. These big rises and the investor confidence indicates that notwithstanding the official denials so far, China will sooner or later pivot towards a less severe COVID restriction, considering impact it has had on their economy. So we expect the risk assets to remain supported, considering that they have been underowned for quite some time. The other factor which was actually overshadowed was the jobs report from US, which showed job creations much higher than expected, wages rising on a month-on-month basis, though unemployment rate also rose from 3.5 to 3.7% versus 3.6% expected. Some analysts have been pointing to gains concentrated more in part-time jobs versus full-time jobs, as also the fact that more people have been taking multiple jobs, which have distorted the real picture on employment situation. With rates still headed more than 1% higher from here, I mean the terminal rate, irrespective of the pace, it's very likely that companies will find it difficult to keep up the pace of hiring, while some companies have already reported retrenchments. Yields have seen a different behavior on Friday, with shorter tenors showing a decline while long end yields were higher, even as the market pricing is still showing more than 0.75% hike in December. The Fed's terminal rate, or the level at which the rates would peak, has slipped to 5.09% late on Friday from about 5.2% just before the US data. The yield curve has slightly steepened between the 2-year and 10-year. Gains for the currencies were obviously led by Chinese yuan, obviously taking cues from the COVID-related news more than easing the post-Fed gains for the dollar. Been observing for some time now that the excessive dollar long position has been weighing on its exchange rate, particularly with regard to euro and GBP, both of which almost matched yuan gains on Friday. At more than 2%, it was one of the largest single-day gain for the yuan. And another currency which caught my eye was the Canadian dollar, where the currency rallied by more than 2% after a very strong jobs report. The Canadian economy added a net 1,08,300 jobs, beating forecasts of 10,000 new jobs. That is 10 times the forecast, while the jobless rate was unchanged at 5.2%, according to the data. The blowout gain was entirely in full-time work, spread across both goods and services sector. Geopolitics has been mixed, with G7 ministers met in Germany issuing a statement which said inter alia that the Use of chemical, biological, or nuclear weapons by Russia would be met with severe consequences, condemning Russia's recent escalations. The group also said it will continue to impose economic costs on Russia and on other countries, individuals or entities providing military support to Moscow's war of aggression. On the other hand, we also have some reports indicating some US official is, trying to negotiate with the foreign minister of Russia to have a direct dialogue on the Ukraine issue. So it's a very mixed picture as far as the geopolitics is concerned. Implications of all these for the rupee is quite mixed. If the Chinese-led recovery in risk asset continues, we would see rupee gain more, but that will be limited also due to higher oil price. Market also avoids our international trade data for October, which has been delayed. And on the flow side, November has seen nearly $1.8 billion of investments from FIS. Outperformance of the Indian markets has been eye-catching, and superior growth prospects may see continuation of the flows, particularly if the broad dollar weakness persists. A continued unabated rise in USD INR, so talking medium-term basis, the continued unabated rise in USD INR for nearly 10 months and a fall of 13% during this period gives a positive twist to it, considering that global markets can also trigger a good pullback. We expect rupee to track the fortunes of DXY and other Asian currencies near term, and possibly test the support at 8150. Break of that can see more gains. Strong resistance at 8290 and 8330 should hold for now. Finally, the key events to watch out this week would be the monthly inflation report from US on Thursday, and before that, the US midterm election tomorrow, where Republicans are set to gain both the House and the Senate. And if we do have such a result, we can see some stalemate in the US lawmaking, as well as the fiscal restraint can come. So the challenges for the US economy may just be starting, and repricing of the dollar maybe just in the offing sooner or later. Finally, tomorrow the markets are also closed in India due to a local holiday. So we might see a bit of a two-way movement in the currency as players adjust their positions, for the weekend, for the holiday period. Thank you.
Okay, wonderful, JK. And yes, folks, there has been a lot of movement in the financial markets, especially on the commodity sides as well, as we are seeing major commodities rising quite efficiently and interestingly. But as JK mentioned, there's been a slight dip in the terminal rate expected for the US from 5.2 to 5.09, which is quite interesting. And a lot of folks in the financial markets have been asking everyone to focus on the peak of the terminal rates instead of the pace at which we arrive at those particular rates. Interesting perspective for the market participants. But yes, there has been no respite on the geopolitics end, though. We are expecting a lot of economic data in this particular week as well. Largely watched will be the Thursday CPI data, while we also have the US midterm elections tomorrow. On the domestic front, there's one news to cheer about, as the government has allowed export of 6 million tons of sugar on a quota basis till 31st May 2023. Now, initially, this was restricted by the government, and even though it was restricted, we've seen a good approximately 11 tons of sugar exports during this period as per the available numbers. So domestic markets are also opening up, and our numbers have any which ways been comparatively better. So let's see how things go about. Thank you so much for joining and listening in today. We shall come up after the holiday tomorrow on Wednesday. That's it for today.